Hello everyone, welcome and thank you for joining our webinar today. I am Komal from My Time Equity and we are happy to have you with us today. In today's webinar, along with Sudhir Pai, we have with us Anup Nayak from My Time Equity. Before we start the webinar, I would like to take this opportunity to introduce you to My Time Equity and Sudhir Pai. As an actively managed portfolio management and RIA firm, MyTime Equity takes pride in being your dedicated partner on this financial adventure. Sudhir Pai is a founding principal and serves as a fiduciary investment advisor representative for the firm. Before I hand over to Sudhir, let me take you through the disclosure slides that our attorneys mandate that we show prior to every webinar. If you have any questions during the webinar, please type them into the question box and we will address them during the Q&A session. If you need Sudhir's help, please write to wealth@mytimeequity.com or call us at 972-330-2771. Over to you, Sudhir.
Thank you, Komal. Can you hear me?
Yes.
Okay, wonderful. So very good morning, ladies and gentlemen. Thank you for joining today's webinar. Today, the theme of this webinar, apart from the market update, is innovation. Is innovation fueling the growth in the US market? That is the theme of today's webinar. But before getting into that subject, let me quickly take you through what happened in the equity markets and the commodity markets. The markets were really great. We closed both the S&P 500 and the Nasdaq 100 on a very positive note, very eventful week. 1.5% on S&P and 1.9% on Nasdaq. And silver was a major outperformer. And silver is in our portfolios, which all our clients enjoy as part of their diversified portfolio. We saw, silver gain almost 9%, and Bitcoin was flat for the week. Now I'll take you through our overall metals and crypto, portfolio, which is there in every client of ours, and we'll explain you in detail how gold and silver and Ethereum and Bitcoin kind of did very well when you look at the summary of the week's outcome, from Monday to Friday. And when it comes to tariff, there was not too much of news, but we saw some amount of good information coming from the White House about President Xi and Donald Trump having an interaction on Thursday, which sounds like it's all going towards the right direction, because the previous conversation that Scott Bessent had with the Chinese officials, which was a very positive thing, that's when the market started outperforming. And on around Monday timeframe, there were some news that the deal is falling apart. So that is where both the presidents had to talk, and I think there is a consensus on the rare earth natural resources deal, and they are trying to work out other parts of the deal. So I think this thing is going to take some time, but I think the uncertainty is there, but not as much as what we saw during the Liberation Day, when we saw a huge drop in the market on April 4th. That uncertainty is gone. So us seeing the lows that we saw in April, I don't think we will see that. And that opportunity of buying more stocks, when the market takes such a big dip, I think for those who did not get back in the market, who are sitting with cash on the sideline, or those who went into cash and never came back in the market, they missed that opportunity of coming back in the equity markets. The jobs report was very positive, and that is the reason we saw Friday to be an extremely good day. We saw all the indexes above 1% yesterday, and there was also a little bit of tweets and fights and bro romance, whatever it is the news media says, between Elon Musk and President Trump. We were expecting that to continue for some more time, but there were interventions by other leaders like Bill Ackman and the White House officials. Both sides kind of stopped, both these high ego alpha men, to stop their tweets and kind of put a stop to Tesla continuing to fall further. By the way, Tesla is a very strong company. Just with the two of them fighting with each other will not shake the company that much. But but it did impact the market on Thursday. But Friday, Tesla regained almost 5% back from its 15% downside that it saw on Thursday. So overall, markets were good. S&P touched the 6,000 historic mark, and the momentum is fully on. And I personally think that next week is also going to be a good week. And there are a few very important macros that are coming out next week. We'll go through that slide as well. Next slide, Komal. Okay, so there is a bit of a lag when we move the slide, so please bear with us. There is 4 to 5 seconds lag. Now coming to the topic of the day, innovation. We saw extremely good results, earnings from most of the tech companies, except for very few which did not give great guidance because they announced the results, pretty early in the cycle, and the guidances were not, something that the market was looking forward to. But overall, if you see the numbers, if you look at the chart on the left hand side, in 2000, the tech spending towards as part of GDP, was 2.5%. So not a significant number, but not a huge number. But if you look at 2023, that has tripled. That means there is a lot of money spent in the US economy towards technology, and US economy is the technology leader of the world, with all the Magnificent Seven residing in the US, getting registered in Delaware, and doing global business. US continues to be the global leader. Europe did not really put all that effort and make all those investments in the last 20 years, whereas US did spend that, and dollar as a reserve currency also helped. And NASDAQ, the electronic stock exchange of the world, was set up just to put all the technology companies in the IPO market. So all of that really gave a big boost to the technology companies. And if you look on the right hand side, the annualized return of the top 100 technology companies in the US, which is represented by NASDAQ 100, the returns were close to around 15%, the average returns. Whereas if you look at S&P 500, it's around 10%, including dividends. And the MSCI World Index, was around 8%. So if you look at this chart, it is the reflection is that NASDAQ is trending and it is ahead of the game. These are all growth stocks. Technology can go up very fast, can come down very fast too. So if you look at 2020 numbers, the drop in NASDAQ was much higher than S&P. S&P is like a bellwether index. It has all kinds of sectors, staples and other defensive stocks like healthcare and all that. But if you look at NASDAQ, it is purely technology, and we have seen NASDAQ outperforming the S&P for sure. But during the drawdowns, whether it is dot-com bust or COVID, the drop in NASDAQ was also very high. Now, the reason why it is very important to keep in mind the drop is because the necessity of having that cash for you, it depends on your age and your need for cash. If your kids are going to college and that year if the market drops, you would end up taking a big hit when you sell. So you have to be very careful with your investing, and you have to really figure out how to invest, where to invest, which asset classes to invest. Should you go risk on equity or risk of bonds or alternative assets? And you should also look at which country is doing well, which commodity is doing well. That's very important, and that is what we preach at MyTime Equity. It's not important to make the highest return. What is most important is not to lose money when you are about to sell. So you need to have the capital preserved, and you should generate returns, because money can be made any day. But if you lose your capital, then there is no more money to grow that money. So you have to be very careful on how you invest, and that is what is something that we do at MyTime Equity. A lot of diversification and and that diversification is made based on the research that we do. macros, seasonality, fundamentals, technicals, and all of that. Next slide, Komal. Okay, continuing, why innovation is going to be number one for the next 10 years, and why blockchain, which is represented by Bitcoin, which is a scarce, asset in the world today, are going to do well. These are some of the data here. So 2024, we saw more than 1,400 ETFs that were launched, just targeting the technology sector. So you can see how much money is flowing into technology, how much money is going into innovation, how much money is going into the blockchain. All of this is a clear indication that AI, which is artificial intelligence, robotics, electric vehicles, and blockchain, and all the other technologies that is being developed, and all the infrastructure that is being put in, by companies like Nvidia for mega computing servers, setup of infrastructure facilities, generating so much of computing power. All that is going to be the infrastructure that is going to be laid down. So this is exactly like what we saw in 1990s, where cables were laid under the ocean to create the connection between US and the rest of the world. So that is what made the world flat, and that is why internet came into existence. Then came the mobile apps, and then came all the other technologies that we are seeing today. So I think we are at that stage now where infrastructure is getting set up for AI to take the biggest leap of technology that we have seen, and blockchain is going to further it, because it is going to create a peer-to-peer network with multiple layers, and it will remove a lot of uh, bureaucracies and costs involved in the financial sector. And you can see this very well because 11 ETFs were created just for Bitcoin in 2024, and the first Bitcoin ETF was launched by BlackRock, Blackstone, and then came Fidelity. So there are 11 other largest companies in the world, who have set up Bitcoin ETFs. Then came Ethereum ETF. Now there has been approval for Solana and XRP. So all these very strong large cap tokens which are used in building technology on the blockchain, all of this is going to come into existence, and the early adopter, I think, is going to be on the top in terms of return on investment. But at the same time, these are also very risky bets, because not every technology succeeds. So it's a high risk, high reward stuff. So you will have to really see how much of your money you should put in high growth technology as well as blockchain, because one thing that comes along with this is also very high volatility. You saw what happened on Thursday, a couple of tweets from Musk, bad mouthing Trump, and then messages from Trump saying that he's going to cancel all the contracts that has been given to SpaceX and Tesla, drop the market like 15% in one day. So the drop can be huge if there is anything negative, because the forward PE of all these companies, the multiples that the market gives to all these companies are heavy. Like Palantir, for example, the PE ratio is in excess of 80, and all the Magnificent Seven companies, the PE ratios are in excess of 40. So while S&P 500 is around 22, which itself is kind of very high, with the high PEs, any negative news can bring down the stocks down like by a crazy amount of money. And there is a lot of loss that can happen, if there is something not right, if the technology is not right, like what happened during the launch of DeepSeek. Nvidia saw a huge downside. Then the whole question was, is all the capital expenditure that all the companies in the US are spending, does it make any sense, right? And that is what got proved in the last 2 months. All the earnings and all the guidances, all the CEOs talking, they clearly said AI is not a hype. All the money being spent is real. DeepSeek might have got their servers from some other place. They may have got some of the things done for a much lower cost, but that doesn't mean that AI is a hype, or it's a bubble that is out there. So I am very confident of technology. I am super bullish about technology and blockchain both, and that is where we launched our crypto fund last month, and our crypto fund is already about 15% plus so far. You can never say that it will do very well for the entire month because volatility is very high. Last week, on Friday, Bitcoin did very well, and that kept our metals in crypto model in on the right side of the growth of our portfolio. Next slide. Okay, so regarding tech and communications, because communications sector as a sector in S&P 500, S&P 500 has 11 sectors. Technology and communications. I have companies like Meta and Netflix. These companies, while they are, Netflix, for example, is is a way to watch, movies and all that we used to watch in theaters. All that is today coming directly to a room, but the technology behind is what gives it the multiple. And today we see Amazon also in Prime, but you can order stuff from Prime directly when you're watching a movie. So all these technology integrations and all the artificial intelligence that makes this technology possible and easy. So all of this, if you look at the overall earning of S&P including technology and communication, it expects about 14% growth. Whereas you remove these two sectors, you see the line going down, which is around 3 to 4% for 2025. So if you just invest in technology and communication, you are looking at close to around 10 to 11% growth, because that is the future growth potential for technology and communication. And that is where we are very bullish on technology, and we are going to continue this for the next few months till we see a dip in earnings or something really negative from what is going on in the market. And for the Q1 2025 artificial intelligence related boom, it contributed almost 1% to the US economy. So overall, technology is in the forefront right now. Next slide. Okay, so macros for next week, there are very important macros. Monday and Tuesday are going to be quiet days, except for the messages coming from White House, which has become normal these days. But if you look at what are the macros coming out, we have the core CPI, the inflation numbers, and the PPI, which is again the inflation numbers, the producer purchasing index. So both the numbers are coming out on Wednesday and Thursday. And then we have the initial jobless claims. So so both are representation of how the economy is doing. If inflation is high, if claims are low, then the Fed is not lowering the interest rate. Now Fed has to lower the interest rate because the cost of this high interest of 4.5% is costing a lot to the US budget. And two, if the interest rate is this high, the small cap companies, the Russell 2000, and all the smaller and mid-sized companies will not be able to have cash at the for the right cost, and that can cause little bit of lesser transaction volume, and can generate a recession in the economy. So interest rate cut is very important. We saw Europe cutting its interest for almost 10 times. They actually had a 25 basis points cut last week. So there is a lot of pressure from the White House to the Fed governor, Jerome Powell. And there was some news this morning, I don't know if it is fake or real, that Trump has plans of replacing Jerome Powell, and he wants a 1% cut by end of this year. Now all of this is not that easy, because Fed has its own independent authority, and that is the very important foundational aspect of the US, that federal bank has a lot of independent authority over the interest rate and what rate to set and all that. And then we have the 30-year bond auction also on Thursday. So both of these days are extremely important days. It can make or break the market. We can see between 1 and 3% move either up or down. But in my personal opinion, we should see inflation falling down. We should see the producer purchasing index also kind of going down, because tariff has really created a lot of import that took place last month. So all of that, if you kind of counter and adjust, we should be seeing PPI also kind of go down lower. The most important thing will be 30-year bond auction. We have to see which other country is going to buy bonds. If there is a problem there, we can see a huge correction. Or if the jobless claims are on the higher end, market may see that as a good thing, because there will be pressure on the Fed to lower the interest rate. So all of these things we have to see on a day-to-day basis, make adjustments to our thesis and to our model if need be. So that is where MyTime Equity spends a lot of time in understanding what's going on in the equity market, in the bond market, in the commodity market, all over the world. And this level of active management, I don't think any other company would do. Now, active management has pluses and minuses. The thing about us is we try to protect the capital, right? We always want to protect capital. Money can be made, but you don't want to lose capital. But for those who are very patient and who have a lot of time, we also look at long-term retention of those stocks and not generating a tax gain or a tax loss. And all that is part of a one-on-one discussion that we have with our clients to decide how to make investment with their money in the equity markets. Next slide. So this table shows performances of our equity models. On the left hand side, you see all the index listed. S&P was about 1.65% for the month and 1.65% for the week. And year to date, it's 2.54%. And if you look at our ETF models underneath that, all our ETF model on a standalone basis did pretty well. Growth was around 6% up for the year, value around 3.85, next generation about 3.32, small caps, metal and crypto, which represents gold, silver, Bitcoin, Ethereum, 15% for the year. International model did 16% for the year, which has Europe, China, India, and Japan. It did 16% for the year. And if you look at the individual stock portfolio on the right hand side, these are all thematic models. All the models have done very well, right from tech model to high beta to all weather to S&P Nasdaq. All of the models have done very well. Now, if you look at the custom model, which are the models where we manage actively by moving money between one ETF model to the other, these models are managed keeping in mind the capital preservation, as I said. So we have multiple models here: less than 10K account, less than 50K, and then margin, which takes 20-30% margin on top of your account balance. So all of these models have done okay. The margin model is very close to what the S&P is, but otherwise, the Schwab model and the IBKR model took a little bit of beating because when we got out of the market on the Liberation Day, we didn't catch the bottom at the right time, and we invested 1 or 2 days after the market started shooting up. So we lost a little bit of alpha there, but I am sure we will catch up very soon, with the revised thesis that we have in place. Next slide. So we have few structured notes to kind of showcase in today's webinar. This structured note, for those who are joining our webinar for the first time, a structured note is a high yield note. So if you go to the bank, give $20,000 to the banker and say keep a CD, for 6 months, 1 year, 5 years, 3 years, they give you a return of anywhere between 4.5 to 5.5%, depending on the length of the CD. Now this is like a high yield CD. Now this is issued by the bank. Like here the bank is BNP Paribas. Now here we are able to get much higher return than what you will get on a bank CD. There is no eligibility criteria as to who can invest in these structured note, non-accredited, accredited, whoever can invest. And the way the bank generates a higher return is by placing reliance on certain stocks. In this case, the stocks that have been chosen by this bank is Nvidia, Palantir, and Tesla. All of these companies are S&P 500 companies, very strong companies, and large cap companies. So this note is a 100% principal protected note, meaning one thing that will never happen is you lose money if you invest in this, unless you try to sell it before the end of the term. The term on this note is 5 years, and the bank can return the money back to you at the end of year 1. Okay, so the bank has the right to return the money back to you at the end of year 1. Now this note, is a principal protected note, as I said, 5-year note with the bank having the authority to return after 1 year. And the way this note works is if you hold this note, if you and the bank both hold the note for 1 year, you will be getting principal and 11.5% as long as all the 3 stocks are not below 95%. Okay, if all the 3 stocks are not below 95% of the value of the purchase date. Okay, so let's say we bought this note with these 3 stocks, and the price of all 3 stocks was $100 on June 18th. That is the date when we place the trade. If these stocks are not below 95% at the end of year 1, you get your principal and 11.5%. Okay, now if it is below 95%, 1 or more stocks, it goes to the 18th month, and at the end of 18th month we again check, is the price of all 3 stocks above 95% from the date of issue, and if it is, then you get principal plus 17.25%. So if you see, the principal plus number keeps going up with time. At the end of 1 year it checks, 18 months, 24 months, 1.5 years, and 5 years. So that is how it keeps going on, and you keep making more with time. So you're not losing your money at all because it's principal protected. Number 2, the more time the note is held by the bank, because the bank cannot return the money for at least 1 year, that problem is not there. So they have to give you the principal back along with that 11.5%. And if they are not giving you that, the reason is 1 or more stock is below 95% from the price of June 18th. So if you think these stocks are going to fall, and we talked about technology just now, we talked about Tesla just now, if these stocks don't fall below 5% at the end of 12th month, then you make your principal and 11.5% money is protected. If you keep the money with the bank, you get about 4.5% these days, or 5%, whereas this one gives you a much higher return, and there is principal protection also. And the bank is a solid bank, which is BNP, and it's liquid anytime. You can sell it anytime. This is not like real estate or a venture fund. You can sell it anytime, but if you sell it during the term, there may be implication in terms of not making the fullest amount or the best price. That if all the 3 stocks are very high, and you may not be able to get even 11.5%, you may get like 5% or 4%. Or if the stocks are down, you will not lose money, but there may be a situation where you may have to pay some fee to the bank, 1 or 2%, to exit. So liquid instrument, minimum is $25,000. If you are our existing client, that's the minimum. If you are a new client, we start relationships with $50,000, and this note is closing on June 18th. So if you are interested, please write to us ASAP, or if you have questions, please type them in the Q&A box. and we will take questions at the end of this presentation. Next slide. So we have a few single stock income notes. Income note is where you get paid income on a monthly basis. The previous note that you showed is a growth note, because what is the difference between income and growth? So one, income is comes either on a monthly or a quarterly basis. In this case, all these three notes are on a monthly basis, and income is taxed as regular income for tax purposes, and the growth is taxed as long-term capital gain because you hold it for 1 year and 1 day. But if you exit before 1 year, then you will have to pay short-term capital gains or regular income tax on growth also. But the way we structure it, we keep the growth note returns higher than the income note. That is why you saw the previous note to be around 16%. In this case, the three companies are the same. We have Palantir, Tesla, and Nvidia. But here you get an opportunity to invest in individual companies. Okay, not all three put together. In the previous note, it was all three together. So the worst of the three is the one that is taken into consideration. But here, let's say you want to put $15,000 each or $20,000 each in each of these notes. So if you invest in the Palantir note, the return is 19.5% per year, but interest is paid on a monthly basis. So 19.5 divided by 12. So that's what you get on a monthly basis. We have the memory feature included in this all three notes, which means if you don't get paid a few months of interest because the stock price went below 50%, in that case, you don't get paid interest on for that particular month. But if the stock comes back, because the observation date, you always check whether the stock is higher or lower from the date when the trade is placed. Now the trade date for this is June 13th. So we don't have a lot of time there. We have about 6 days. So June 13th is the trade date. The price of Palantir, Tesla, and Nvidia is kind of captured on June 13th. And if the price at the end of every month, if it is not below 50%, as of that date of payment, you keep getting that monthly coupon. And at the end of the term, you get your money back if the price of the stock is not below 50%, and it's a 3-year note. But the bank can return the money in 6 months. Most of the time with income notes, the stocks are holding strong, that too in a bull market like this, and the bank returns the money at the end of 6th month, or whenever the bank can return the money. In the previous note, it was 1 year. In this case, it is 6 months. And after that, every quarter, the bank will have the authority to return the money back to you. But one thing you should keep in mind, the bank cannot return the money back to you when the market is down. It can only return the money if the market is higher than the price of trade, or it has to wait till the 3rd year. Every quarter it checks and it goes all the way to the 3rd year. So this is a way to diversify your risk, as well as have an instrument that has a downside protection. And if you want growth, we create growth notes. If you want income, we create income notes. So that's the beauty of these notes here. So we have growth note, we have single stock notes, and the companies are same. We have made sure that we keep the conversation simple. So it's the same 3 companies. All 3 companies are solid, except for what happened on Tuesday with the Musk and Trump tweets. But otherwise, all 3 are S&P 500 stocks, good solid stocks, technology backed. Next slide. Okay, I think we added this note at the last minute. That's why it's in this format. I thought we will present this note. It has time till June 30th. We initially thought we will showcase it next week, but then the companies are solid. We thought we should, even though it is putting too many options on the table here, it's like a buffet meal here. You have to decide what to eat, and you have to make sure you don't get indigestion by putting by starting to think where to put your money. But if you want our help, we can guide you as to what is right for you. So talk to us if you have questions, or if you have more questions for immediate that you need immediate response on. We have done a great job educating the community with the structured notes. We have been kind of a pioneer in this asset class, and the market is really liking it. Our clients really like the fact that we bring 2-3 notes every week, and they have a very, very well diversified portfolio with very, very high class companies. We don't deal with meme stocks, small cap stocks. We either deal with large cap stocks or high growth companies that have a moat in them, and indexes. And one other point that I would like to make here is we can create a note just for you. If you are interested in a certain company, if you are interested in a certain index, we can create a note just for you. Now, the catch here is the banks need a minimum of $500,000. Sometimes some banks agree for $250,000. So, if you are trying to invest in a certain note, a large amount of money, please talk to us and we can create the note. If you're not able to put the entire 250 or 500K commitment, we can bridge the gap, because we have several clients who always are looking at different notes to diversify their portfolio. So this particular note has 3 tickers: Apple, Microsoft, and Nvidia. And this is a 3-year note, and the trade date is June 30th. At the end of 1 year, if all the 3 stocks are flat or positive, you make 35%, solid growth, solid return. And if it is not, then this note directly goes to year 3. And in year 3, you get 3x of the lowest performing stock. So if you think the lowest performing stock in this is Apple, because it's coming under a little bit of pressure right now with everything that is going on with China and tariff and all that, involvement of the White House in their business, telling them what they have to do in terms of supply chain and all that. So if you think Apple will grow slowest, over 3 years, then you basically get the return of Apple. So let's say Apple has grown by 30% in 3 years, Nvidia is 100%, Microsoft is 200%, throwing some numbers here. Don't please assume that that's my prediction for these stocks. I'm just throwing those numbers for example's sake. So if Apple is 30% at the end of 3 years, if it is not called at the end of 1 year, most of the time these notes get called at the end of 1 year because they'll be flat or positive tech stocks, and you'll get 35%, right? And for any reason, if the stocks are not positive at the end of 1 year, it goes to year 3, and in our example, the lowest growth stock is 30%, so you get 90%, at the end of 3 years. So which means 30% on an average for each year. And on the downside, you have a protection of 50%. If all the stocks or one stock fall below 50%, that's when you lose money. Up to 50%, there is no loss of money. Your principal is fully protected. And this is a great company, a great bank issuing this, and good instrument for putting some money, because even S&P has close to 35% in all the Magnificent 7 stocks. And these are the 3 big companies, 3 big names within Magnificent 7. So, if you want to put, 5 to 10% of your overall net worth in this, not a bad idea, to think of investing that in this note. Or we can also create a custom note for you. Next slide. Okay, so for those who are who were not present in the last week's webinar, we presented this last week also. I'll not take a whole lot of time. We are working on this particular real estate project in Columbia, Missouri. It's a student town, and we are buying this student apartment complex, made up of a lot of townhomes. It's a $15.4 million deal. We are paying about $5.96 million in cash, and the rest is bank loan. We are able to get bank loan for around 6%, and it has about 82 units and 328 beds. The way this the lease works of this building is it's rented on a number of on a bed basis. This building was built in 2005, and we are buying the property at around 7.4 cap, which means we make about 7.4% on our money. Now, when you take into consideration the annual increases and selling the building in 5 years, you're looking at an average cash on cash of about 13% and projected IRR of about 31%, including the tax benefits, and about 2.6 multiple, including tax benefits. So we can get bonus depreciation on this, assuming that the big beautiful bill gets passed on the Labor Day, and you can invest money in this through your IRA or through your 1031. And you can, if you are interested in putting more than 500K in this deal, we can take you in as a general partner, making your depreciation active. You will have to spend some time reviewing the deal and all that, maybe going with us to look at the property. This is in the student town of Columbia, very stable city. And this is an asset which we can hold forever if you want to, because very good asset. Students are not going anywhere, whether AI comes, whether anything happens. Students are going to pay rent. The rent is guaranteed by the student and their parents, so there is double layer of guarantees. So we like this property. We are doing our due diligence at this time. If you are interested in this, you can send us your commitment. We would expect a minimum of 100K investment in this. We don't want to take too many investors. Between me and my partners, I think we will be putting in close to $3 million in this property ourselves. That leaves another $2 million for outsiders and our clients. And we don't want too many of them, because this is a small deal and we want to wrap it up quickly. So expect money to be invested in this by around August 15th, September 1st timeframe. Till that time, we'll be working on the due diligence, negotiation, and all that. So if there is any interest, please let us know, and we can get deeper into the pro forma and explaining and showing you different pictures and things like that. Next slide. Okay, so we have the opportunity zone fund as well. So if you have capital gains from sale of stocks, either in 24, after November 2024, if you have capital gains from sale of real estate, sale of stocks, any of capital gains, sale of jewelry, sale of property in India, you can invest in our opportunity zone fund. Our opportunity zone fund has this first property that we have invested in. It's a office building, but we are converting this into a hotel. And this building not only is in opportunity zone, which means you don't pay any taxes on the growth of your investment, you will also get a tax credit, because this building that you see is an historic building. If you Google for Scan Land building, this is a building that was gifted by the then president to the governor. So very historic in nature. And the city of Houston wants this to be retained and maintain its historic status, which is why the state and the IRS gives about 49 cents or 49% of your investment in tax credits, which is tax free. So we plan to sell those credits and return that money back to our investors. So we also have a bank which is already signed a contract with us to buy all these credits. So it's an opportunity zone building with the benefit of tax credit and depreciation and things like that. So the one of the requirement here from the IRS is that you have to hold this investment for at least 10 years. So if you are in need of that money, and if you can't commit to 10 years minimum, then this is not the right investment for you. And the biggest benefit of opportunity zone, because you are investing your capital gain, is you don't pay taxes on that capital gain till 2027. And if you invest after 2026, the new law is currently in the Senate, and the information that we get from the committee is that this law will change the date from 2026 to 2023, 2033. So you will get a lot more time to pay taxes if you invest after 2026 January. So for now, you are not paying tax for 2 years, no tax on growth of your money. you get your historic tax credit of around 49 cents on the dollar, and the minimum investment in this is $25,000. Now ours is a opportunity zone fund. This is one of the properties. In our fund, we plan to buy a lot more properties so that we have a diversified pool of assets in our opportunity zone fund. So one of the best tax saving plans out there, it's like a combination of 401k and a Roth plan. And this is our own fund. This is My Time Equities fund, not any fund managed by outsiders. So if you are interested in participating or saving your capital gains tax or not paying tax on this money, then talk to us and we can explain this to you in further detail. The fund is open. You can start investing in it right from the day you decide. Next slide. Okay, short-term rental opportunity. Short-term rental is something that we have started as a business because there was a lot of demand from clients where both husband and wife are working, and they wanted some way of lowering their taxes. So short-term rental is an opportunity to lower your yearly taxes. And the way you do it is, we basically buy a short-term rental property. Short-term rental property means a property which is rented for less than 7 days. So you cannot just rent it for months together and claim the depreciation on this. So we have found a couple of properties in Florida and in Dallas. One property in Dallas is around 800K. We already have multiple offers on it. So if you're looking at investing in such properties, talk to us. We usually don't look at properties which are not going to generate any income. For example, today, if you want to buy a property in Plano or California or New Jersey, you will be paying the kind of money that you're paying. You're not going to make even 2 to 3% return on a monthly basis, right? Because one, the prices are high. Two, the interest cost is high. And if you are buying the property at 4 cap, 5 cap, then you are not even making the return of the cost of the debt, because debt is around 5 to 7%, depends on which bank you go to, and the returns is around 5%. So you are actually losing money on a month-on-month basis. Then the assumption is that it will grow in price. From the last 2 years, we have been in a recession for real estate. This recession can change if Fed cuts the interest rates, and we are anticipating that to happen from 2026. So it's a good time to buy properties because it is the buyer's market right now. And the properties that we identify for you is after a lot of efforts. We have a team of about 6 people just looking at off-market deals, and we have found these properties, in Florida and in Dallas, Florida, because it's a great Airbnb destination, and short-term rentals are either Airbnb or VRBO. So this particular property in Santa Rosa, Florida, generates around 10 to 12% yield. So excellent property. The price is also high, so it's not for someone who doesn't have that kind of money or credit, because you have to stand guarantee to the bank when you're buying your own property. Or if you want to come in with a few of your friends, all pooling in to put 20-30% of the total property price, we can also help you with setting up the LLC and doing all the documentation, getting you a bank loan, managing the property, selling the property. So the whole 9 yards of dealing with real estate is something we can do for you. So reach out to us if this is something that is of interest. Next slide. Okay, I think that brings us to the end, and we are now ready to take questions. Over to you.
Yeah, thanks, Sudhir. I think it was pretty informative, giving an update on the market and talking about the innovations that the country is seeing in the next decade or so, and then also giving an indication of what is upcoming for next week, especially on the producer purchase index, and of course to watch out for the 30-year bond, which might have an impact on the market. And of course, we also spoke about at least 3 structured notes and other offerings. And here are a few questions. I'll try to take a few of them. The first question is, are these the notes that we are showing, are they SEC or FDIC protected, just in case BNP Paribas goes bankrupt? These particular note that we have seen is not FDIC protected. So there is a credit risk if any of these banks goes bankrupt. But remember, BNP Paribas per se is one of the largest banks in the Europe and has been there for more than a century or so. But we do bring FDIC protected note. So in case if we come across, we will definitely let you know in the future. Okay. We did bring one last year.
The disadvantage of an FDIC protected note is the cost, because FDIC costs money. The insurance cost in FDIC will be an additional cost to the yield, and the returns will not be as high. So if you are getting a FDIC insured note, typically it's on the index, not on an individual stock, because FDIC isn't protecting an individual stock. So it has to be the index, and the returns are usually between 6 and 8%. But we can look this up for you. But the yields are low, just to keep it in mind.
Yeah. Thanks. Sudhir, yeah, any riders that we add that will have an impact on the lead? There are a couple of questions on 1:1 loss. For instance, if there is a 50% protection barrier, if a $100 stock ends up at $45, will there be a loss of $55? Answer is yes. So when we say it is 1:1 loss, it is you lose accordingly after the 50% barrier. So that is what it means by 1:1 loss. Third one is, thanks for the comment here. Really enjoy these sessions. Very much appreciated the efforts that you're putting. One feedback, these structured notes are focused on tech stocks, mostly on a 52-week high or a combination where the risk is risk of return. Before Sudhir comments, I just want also to mention that, while it seems to be tech stocks, in the past we have bought stocks that are index based, and recently we have had the healthcare, United Healthcare, and past we also bought Netflix, Broadcom, and in few cases the Chipotle as well. So yeah, we try to bring in variety of stock, but Sudhir, if you want to comment additional on that, please do so, Sudhir.
Yeah, certainly. So the yield or the growth, you get that only because of the volatility that's there in the underlying asset, the stocks of the ETF. So if you take a defensive stock or a consumer staple stock, these stocks are not very volatile. And in fact, these stocks have not been doing well over the last multiple months because of the tech boom that is going on. While we understand we are bringing a lot of tech stocks, as I said, we are very happy to also create custom notes for you, but you'll have to then put a larger amount of money. So a combination of tech stock and a combination of indexes, as Anup said, I think will be a good way to diversify your portfolio. And on the downside, we typically add 50% or principal protected note. So if you are able to get a 16% return on a principal protected note, then the way I look at it is, how does it matter whether it is tech stock or a defensive stock, right? Because defensive stocks are not that highly volatile, and the returns that the bank would offer because of the derivatives underneath it does not generate that kind of call premiums and put premiums. So that is the background behind tech stock. But as I said, we are not married to only tech stocks. The only reason why we believe in tech is for all the reasons that we mentioned just now.
Thanks, Sudhir. And a generic question, top 5 factors while guiding your clients in structured note investment and other investment that we consider at MT.
What is that? Can you repeat?
Yeah, top 5 factors while guiding a client while investing in structured notes or other investment vehicles.
Yeah, so it depends on the risk profile of every client. Sometimes the clients come to us not with all their money. Now, if you want us to do a complete financial plan and guide you where exactly you are supposed to invest your money, and based on your risk appetite, your goals, your need for emergency cash for certain expenses towards kids and family, we can come up with a full-fledged financial plan. But most of our clients usually, they end up managing the money on their own for some time. They start investing a little bit of money in each and every investment opportunity that we bring. And some of the clients bring all their money and give it to us and say, okay, help us with the financial plan. But at a high level, we see what is the risk appetite, goal setting, accredited, non-accredited status, and kind of come up with the plan. Recently we met one gentleman, whose age is around 65. We ended up buying a annuity plan which has a guaranteed income for life. Okay, so we also deal with the very high quality annuity plans which gives around 10 to 14% in bonuses. So when you sign up, it gives you 10 to 14% in bonus. You can do this in your 401k, you can do this in your with your regular money, and when you do that, you get pension for life, right? So that was the right investment for that person. We did not talk to him about these real estate investments or this the short-term rental opportunities and all that. So what we do here is demonstrate what all we do. Then we talk to you one-on-one, and then we decide what's the right investment for you, and then you make a decision whether you like our suggestion or not. Sometimes if you're looking for a double-digit return, then obviously higher risk has to be taken. Now higher risk comes with higher reward, and now lower risk is lower reward. So it's a conversation, it's a educational process, and investing and making changes to the model as and how we go.
Thanks, Sudhir, on that. And coming to the real estate price goes down and the returns, and if there are zero returns, will the investor get tax benefit because of those losses?
Yeah, so real estate, the beauty of real estate is, one, the interest is deductible. Two, buildings are allowed to be depreciated. And if we do accelerated bonus depreciation through engineering study, we can write off good 40 to 90% of the investment in year one. And sometimes it can be almost 2 to 3 times of your investment if you are investing in gas stations or convenience stores. We have those options also. And these properties that we buy are not purely for depreciation, but when we buy properties, we ensure that the property makes money. Money is in two forms. One is the income that gets generated month over month, and growth from the inflation and increase in rents, and which is usually around 2 to 5% on top of the distribution that you make. So income will be around 5 to 7%, and growth will be about 5 to 7%. And after you offset the depreciation benefit, you should be looking at anywhere between 1.5 to 3x return on your money over 6 to 7 years. Because we have leverage, we have the bank's debt, which is coming at a much lower cost than equity.
Thanks, Sudhir. And the next is on crypto funds. How to regularly track the crypto fund performance?
Yeah, so we will be sending a monthly statement. We have chosen NAV as our third-party administrator. It's a large accounting firm. They manage thousands and thousands of hedge funds and crypto funds. So they will be sending a statement for every month. For example, the closing of May just happened, and I think they should be sending out a statement in about 10 days or so. And every quarter also there will be a quarterly statement. And we plan to hold either a quarterly webinar or a monthly webinar, quarterly for sure, talking about how the fund has done. So this year, this fund is a very new fund. So we did well for the month of May. June also looks very promising. Yeah, so you should receive a statement from NAV very soon. And at the end of the year, we get the books audited by Spicer Jeffrey, and the K1 follows the audit. Usually, the K1 and the audited financials comes around the month of February or March.
Okay. The next question is, can you talk about investing in CRCL post IPO?
No, I'm not aware of CRCL. What is CRCL? It's an Indian IPO.
I do not have that information.
This is Circle IPO. Yeah, which is already, yeah. I think we are talking about Circle IPO. Yeah, we don't have any pre-IPO stocks, or we are not participating in that.
Okay. The last question is, I'll take this. In today's first notes, Tesla, Palantir, and Nvidia combine and individual notes, which one would you prefer if you had to select one? And I think, as Sudhir said, each client has got his own need, and then we will have to look into the risk profile. What is that they're looking? Are they looking for the income? Are they okay to take a risk, or if they want protection? So it is not a cookie cutter. It is very customized. So that is why we encourage all who are interested to either drop an email or call us. We'll be more than happy to discuss and see what is mutually benefiting, what is benefiting you, and then we can suggest what could be the one. Okay. So
Yeah,
that is all the questions that we have. Yeah, sorry,
yeah,
Sudhir.
sorry to interrupt.
Yeah.
Before I forget, I just wanted to mention this. There is a QR code on the screen. So if you can scan that using your camera on the mobile phone, it will add you to our WhatsApp group. So please join our WhatsApp group. We post daily updates. We post all these structured node opportunities, and I think that will be a good place for you to kind of read through a lot on a daily basis.
Okay, thank you, Sudhir. Yeah, that is very much needed, and we are on top of the hour. So thanks, Sudhir, once again for taking time to educate the community. Thanks all for joining. All have a nice weekend, and any questions, to reach out to us. Thank you.
Yeah, one is also Anup. Father's Day is coming, so we have a special code from a company called Viome. I have tried this. They do a complete gut health check, and it has benefited me a lot. So I have worked with them and got a $100 discount. So if somebody is interested in getting their gut check for their wellness, we should always focus on health and wealth, right? So I'm trying to focus on mine, and whatever I do, I'm trying to also bring that up in every session that we do. So we'll be sharing, the discount code for Viome for getting your checking done, health check done. So take advantage of that if you're interested in understanding how your body is doing in terms of wellness.
Okay, thanks, Sudhir, for that bonus offers. Yes, health is also equally important. Yes. Again, thanks all. All have a nice weekend. Thanks, Sudhir. Thanks, Komal, and thanks all. Bye.